We've entitled it this time Emerging Light with a question mark, but nonetheless, there is a sense that there is light at the end of the tunnel. And we're seeing some positive data. It's still early, but it's emerging light. Let's start with equity markets as of year-to-date 2023. So we've been through a month of 23, and what a month it has been. It has been a very positive month for markets. In fact, if you look at just the global equity returns across these different indexes, it's been about a year since we've seen a positive returns across the board. It's really been a very positive start to the year. The S&P 500 is up 6% year to date. I think the big story is the NASDAQ and how the tech-heavy NASDAQ index has really rebounded 11% in January, which is really remarkable. Before any of us get too excited about 11% return in January, I'm reminded that it was we had a 10% return on the NASDAQ back in 2001. And you may recall that the year ended down 33%. So we're off to a good start. We've seen it before. It doesn't mean that it's going to be a terrific year, but it sure is good to see the strong start. In fact, as we think about NASDAQ, just today, the company that was Facebook, now Meta, had its best single-day performance in 10 years. It added $100 billion to its market value, up 23% today on some positive news. So technology growth stocks really have had a good, strong start. And we see that across the board in the European markets, in Chinese markets. And in fact, this last item, the MSCI ACWI, I'll remind us that it's an acronym for All Country World Index. If you look at all securities across the global economy, they're up 7% to start the month. So let's hope that continues. As we look just at the S&P 500 and sector performance, we see the green continue. Again, it's been a while since we have seen kind of a broad-based rally in the S&P sectors. If we reflect back on 2022, as many of you know, energy really was the only sector that had a positive return. So we had one of 11 sectors with positive return in 2022. So far this year, we have 8 of the sectors in positive territory. So it's a broad-based kind of return, and it's really a good start, good to see. In terms of interest rates, we track the 10-year Treasury as a bellwether for interest rates. Interest rates have fallen across all different types of instruments. We'll see some of this, but today the 10-year Treasury yield is about 3.5%. It's down 70 basis points roughly from its highs in October. So it's good to see interest rates begin to moderate, settle in, stabilize, and have a return back to something lower that we would expect. It really is driven by, I think, a reassessment of the economy, of Fed action, and other positive attributes of the market. So that's another positive sign. We still have a negative or an inverted yield curve. And as we've talked about in the past, the yield curve, and what we mean by that is if you look at the maturities, typically you would expect shorter maturity Treasury bonds, in this case, to have a lower yield than longer maturity Treasuries. So you'll hear the market people talk about the 2 to 10 spread. Normally, that's a positive spread. You would see an upward sloping yield curve. Here we have a negative yield curve. It still is inverted by about 70 basis points, 2 years to 10 years. And we know that an inverted yield curve really is a strong signal, leading indicator to recessionary pressures. We probably are in a recession technically right now, but the positive thing is that we're seeing a flattening of the yield curve. It's not nearly as pronounced or flashing as brightly to us as it was before. It's improving, but still it's an inverted yield curve and something that deserves our attention as we move forward. So this is all sort of altogether different in tone and tenor and in sort of spirit of where we were the last time that we had spoke. You know, this is a slide that I took from the deck that we had shared the last time that we had come together, and we were talking about climbing a wall of worry. And if I recall correctly, we had 4 or 5, maybe 6 slides following this, all talking about different aspects of the market that just were cause for concern. And it's a big difference from where we are now. If any of you read the Fed minutes, Jerome Powell's comments, maybe saw headlines in the newspaper, this is a quote from Jerome Powell, his prepared comments to the press and to the market. Well, what he said was the inflation data we've received over the past 3 months has showed a welcome reduction. Although the developments are encouraging, the Fed is still cautioning that they'll continue, to be vigilant on inflation. So what it says, I think, if you translate this, is we like what we're seeing. We're cautionary. We're not going to change our course, but we like what we're seeing. So what I'd like to share with you are just some of the data points that the Fed's seeing and the market is seeing that's giving it confidence, and I think is a catalyst for the upward movement in risk assets. The first is just simply changes in inflation and a moderating inflation picture. We know that big spikes of inflation historically have been transitory. That means that after a spike, you see that inflation moderates. We saw that, in the 70s and early 80s. The sense is that we will see that again. Inflation is coming down, and I expect the next print of inflation to continue to show this trend. Part of it is, there's many aspects to what is driving lower inflation rates, the Fed policy really taking a bite, being effective, but there's been some luck as well, particularly around energy prices. I think one of the very positive drivers has been that the winter in Europe has been much warmer than historical norms, and the high demand that was expected for energy in Europe has just not materialized. And there's a number of those types of anecdotal kind of things happening in the market that in some really have set up for a declining inflation picture. Let's hope that it continues. Expectations are that it will. So this is something that the Fed is looking at. Another thing that the Fed is looking at is just the resiliency of the US economy. One of the things that you'll hear about is a soft or a hard landing from Fed action. A soft landing would be that inflation comes down, that the economy continues to move forward, that the employment picture continues to be strong. And it's also called the Goldilocks scenario. And we're seeing that begin to come true. Inflation's coming down, but yet we're still seeing resiliency in the domestic economy. So the most recent GDP numbers, fourth quarter 2022, GDP was up at an annual growth rate of nearly 3%, which is a really very hopeful sign. Employment as well. The Fed, as we've talked about before, really has 2 jobs. One is price stability, which is inflation. The other is full employment. And the Fed wants full employment, but not overheated employment. And I think, over the past months, there's been some sense that the market just is overheated, but it's now moderating. And we see the growth of, or the change in jobs, the most recent report from December, still being a positive change in jobs, which is healthy for the economy, nearly 250,000 jobs. But the pace is moderating, which is very positive. And less positive is, but a fact of the cycle that we're in is that we're seeing more and more headlines of job reductions and layoffs, and it just speaks to a cooling job market, which is really important part of the cycle. So the inflation's coming down. We're seeing stability in the job market, which is important. And then interest rates as well. We saw this with the 10-year Treasury rate that they've moderated and come down a bit, but we're seeing it on things that really matter to each of us, which is mortgage rates. And this has really been driven, I think, primarily the Fed action. One of the concerns was an overheated housing market and demand for housing. And with mortgage rates spiking as they did to 7% or more, it really brought a cooling effect to the market. The housing market has cooled. There's less demand, which means that there's room for mortgage rates to fall and to find some equilibrium. So these are all kind of glimpses of light that we're seeing emerge from the market, which ultimately drives Fed policy. The most recent Fed increase was 25 basis points. That's on the heels of a series of 75 basis point increases. So we're seeing the rate of increases moderate significantly. There are more increases ahead. If you listen to the Fed, they're very clear on that. And but nonetheless, we're seeing the program, this rate hike cycle take effect, and we're beginning to see the fruits of that. So the Fed points to a number of very positive developments in the market. These are some of them. So what do we think about looking forward? All of this is still a work in progress. I don't think that there is a solid case for us to say we're out of the woods yet. And one of the things that we need to be focused on is earnings. And, at the end of the day, account values, asset prices are driven ultimately by earnings. We're already in a corporate earnings recession. So if you just think about what a corporate earnings recession is, well, I'm going to come right back to that. This is a price graph of just S&P earnings. You see that there has been a slight decline over the last couple of quarters, so that the S&P earnings rate in aggregate is going to be about $187. Now, on this slide, what we're looking at is actual US corporate earnings and projected earnings in 2023. So I started to say that we're already are in a corporate earnings recession. So we've had 2 quarters of negative growth in earnings, which by definition is a corporate earnings recession. The street estimate, the consensus is that we'll continue to see some declines in corporate earnings before a rebound. So the question is just how pronounced that may be, if there is a decline in earnings at all, and what that will do to asset prices. Asset prices are a combination of earnings and a price multiple. The price multiples have fallen very significantly over the past year. There may be some headroom for them to bump up to compensate for lower earnings. We'll see, but it's something to watch for sure. So as we go forward, I'd like to leave you just with one last slide, and that is a case for optimism. So if we look back to the last 60 years, back to 1961, there have been 7 events or 7 periods in the market where the S&P 500 has fallen 25% from its highs. And you can see those periods, 61, 68, 73, and on. 2022 will be the 8th of these cycles. They're painful. We know that. The upside is that after such a sharp decline, historically, we've seen a very positive forward performance from the S&P 500. So you can see on average, if you look at these 7 events, historical events, the average one-year return following a 25% decline is nearly 17%. For 3 years, it's 37%. Over a 5-year period, it's 83%. In 10 years, we more than double our money. So our hope is that this trend, this historical kind of pattern will continue, and I think that it is a case for optimism. Yes, it certainly can. We know that the market hates uncertainty nearly more than anything else. So if there was some change, if there was some catalyst, if there was some escalation in the war, by all means, it's going to have a negative impact. And as we think about it, we're global investors. So the closer you are to it, I think the more pronounced. I had mentioned earlier that the sense that there would be a real energy crisis this winter in terms of heating has not materialized because it's been a warmer than expected winter. But yes, I mean, we have sanctions, we have abnormalities imposed on the economy right now in terms of free flow of things. So it does have an effect. I think the biggest concern is that there's some event, a nuclear event, an escalation in the war, something happening to bring it out of the containment of Ukraine to cross the borders. So yes, there is a risk there for sure. So it's a good question, and it should be on all of our minds. So you can see the performance here. It's just heartening to know that you can invest in the way that the foundation does, following Wesley's 3 simple rules, and still do well financially. So we've been pleased with the managers and pleased with the work, and I hope that as you meet with your colleagues and your committees at your local church, that you're able to see the performance and feel good about it, and feel good for what it means for your church and the resources. Last year was a tough year across the board. There were negative returns, but they weren't as bad as they could have been. And weren't as bad as the broad market benchmarks.